So taxation of specialized businesses is what we want to discuss today. Company income tax contains special provisions. So company income tax contains special provision as regards to company engaged in shipping, air transport, as well as telecommunication, bank, and insurance. So the provision below are the normal rule for allowing allowable expenses and disallowable expenditure in tax practice. So in tax, there are some businesses, because of their nature of operation, because of the way that we compute their tax, we call them specialized business. Specialized business. One of the specialized business that we have is airline, shippings, and telecommunication company. One of the specialized business that we have is airline, shipping, and telecommunication companies. That is one of the specialized business we have. Second specialized business that we have is banks. Why the next specialized business that we have is insurance business, taxation of insurance business. We also have another specialized business called unit trust business and pension fund. Unit trust business and pension fund. Unit trust business and pension fund. While the last specialized business that we have is taxation of real estate businesses in Nigeria. Taxation of real estate businesses in Nigeria. Why do we call them specialized business? We are referring them as a specialized business because the basis of their tax computation, the way we compute their tax is different from the normal tax computation of a manufacturing company, service company. You understand? Tax authority give them some special allowances and relief when we are computing the taxes of all these specialized business. And all these specialized business, the way we compute their tax differ from one another. The way we compute their tax differ from one another. We compute their tax, the way we compute their tax differ from one another in a sense that the tax computation of specialized business of airline, shipping, and telecommunication is different from bank, is different from insurance, is different from unit trust. So specialized business tax is the tax computation is different from one another. So that is what specialized business mean. So the first one that we will look at it this morning is taxation of airline, shipping, and telecommunication. Airline, shipping, and telecommunication. Airline, shipping, and telecommunication. That is what we want to look at this morning. Taxation of shipping, air transport, and telecommunication. How do we compute their tax? How we compute their tax? So for this kind of people, for this kind of company, they operate in more than one country. They operate in different companies. Example of that, take for instance, a shipping company. Shipping company will carry cargo from Nigeria to Madrid, from Amsterdam to Nigeria, from Argentina to Nigeria. You can see that they operate from different countries, different countries. Do you understand? Likewise, too, airline, air transport. They will carry passenger from UK to Nigeria, from Nigeria to US. They operate from different countries. Telecommunications too. You will make call from Nigeria to US, from US to Canada, this and so. All these companies, they operate in different companies, different countries. So how do we compute? So what we are after now is how do we compute their tax in Nigeria? How do we compute their tax in Nigeria? That is what we are after. How do we compute their tax in Nigeria? So how we compute their tax in Nigeria? There are steps in which we used to compute taxation of airline, shipping, and telecommunication company. There are steps in which we adopted in computing the tax of airline, shipping, and telecommunication company. There are steps in which we adopted. If you go to page, I think page 4 or page 5, the step is mentioned there. Tax computation of shipping, airline, telecommunication company, step by step. Number 1 step is determine the global income. Determine what? The global income. What do we understand by global income? That airline company, their global income means the income that they receive from all the country that they operated, the income that they receive from all the country that they operated. Based on my notes, I said determine the global income by aggregating all the income of the particular country in the relevant year of assessment. What we mean by that is their global income means their total income in a year from all the countries that they operate. Their income from Nigeria, their income from UK, their income from France, their income from USA. You add everything together. It is called global income. After that, you now need to determine Nigeria income. Determine what? Nigeria income. How do we determine Nigeria income? The income that the source is coming from Nigeria. The income that the source is coming from Nigeria is called Nigeria income. Example of that, income from passenger. Income received from passenger from Nigeria to UK. That is Nigeria income. Income from cargo from Nigeria to Madrid. Anything that starts from Nigeria, that is the source. That is Nigeria income. Income from airtime, abi, telephone call from Nigeria to Canada is Nigeria income. But if they said income from UK to Nigeria, income from passenger, air passenger, UK to Nigeria, is not Nigeria income because the source does not start from Nigeria. The source starts from UK. Income from cargo from Amsterdam to Nigeria. From Amsterdam to Nigeria, it's not a Nigeria income because the source does not start from Nigeria. Do we understand? Do we understand?
Yes, we
Hello,
do,
class.
sir.
Okay. So that is step 2. Step 3, compute global adjusted profits by applying principles of trading profit adjustments. Compute global adjusted profit by applying principles of trading profit adjustment. How do we do that? We compute global adjusted profit. How do we get global adjustment? We apply principle of trading profit adjustment. Principle of trading profit adjustment means we need to consider disallowable expenses and allowable what? Expenses. We need to consider what? Disallowable expenses and allowable expenses. How? Depreciation is a disallowable expenses. General provision for bad debt, doubtful debt, is a disallowable expenses. Donation to unapproved body is a disallowable expenses. Loss on disposal of fixed asset is a disallowable expenses. We consider them. If we want to get our global adjusted profit, we have 2 methods that we used. First one is we can set global income less allowable expenses. Global income less allowable expenses. We get global adjusted profit. Global income less allowable expenses. We get global adjusted profit. Why the next one? We can set net profit add disallowable expenses. Net profit add disallowable expenses.
So I have a question, sir.
Okay.
So in a situation where you make money, take for example, you generate income from UK. That's a global income. If you are taxing them in Nigeria, yeah, and you spend the money in Nigeria, how do you treat that? You generate revenue from UK as an airline, then the expenditure is being made or being incurred in Nigeria. How do you take account of that, sir?
Well, as regards to that, what we are after, do we have Nigerian income? Yeah? If the income, some of the income is coming from Nigeria, is going to be taxed in Nigeria. But if the income is not, if some of the income is not coming from Nigeria, all the income is from UK, it's going to be taxed in UK, despite making expenses in Nigeria. Do we understand? So the essence of this topic now is the only income that will be subjected to tax under this taxation of shipping, airline, telecom is the income applicable to Nigeria. But the expenses is globally. The expenses in this question applicable to all the countries that they operate. So that is the reason why we need to do step. So this step 3 now is for me to compute global adjusted profit. It means the adjusted profit for that they make, the summation of the adjusted profit that they make from all the countries that they operated, including Nigeria. It's not only Nigeria adjusted profit alone. Do we understand? That is what global adjusted profit means. So that is the reason why we said global income less allowable expenses. If in some question we may have net profit, what we need to do is the global net profit add disallowable expenses. So if they want to test question on shipping, airline, shipping, airline, and telecommunication company, the expenses that they are going to give you is not Nigeria expenses, rather is the global expenses. They are going to give you global expenses. Do we understand? Do we understand?
We do understand, sir.
Okay. Now, when you compute your global adjusted profit, the next step, which is step 4, is to compute global adjusted profit ratio. Global adjusted profit what? Ratio. How do we compute global adjusted profit ratio? This global adjusted profit you get in step 3 all over global income times 100 all over 1. The global adjusted profit you get in step 3 all over global income times 100 all over 1. You get what is called global adjusted profit ratio. Step 5, compute depreciation allowance ratio. Depreciation allowance ratio means capital allowance. In taxation of specialized business, airline, shipping, telecommunication company, if the question did not give us capital allowance, we are going to use depreciation as what? Capital allowance. Let me repeat myself again. In taxation of airline, shipping, telecommunication company, if the question do not give us, this is the capital allowance for the year, we are going to use depreciation, that depreciation that we disallow, that is a disallowable expenses. We are going to use it as capital allowance. Now, compute depreciation relief ratio. I want to compute depreciation allowance ratio. That depreciation expenses all over global income times 100. That depreciation expenses all over global income times 100. That is the depreciation allowance ratio. Step 6, compute Nigeria adjusted profit. I want to get Nigeria adjusted profit. How do I get my Nigeria adjusted profit? Gap ratio, global adjusted profit ratio, which is that step 4. Global adjusted profit ratio, step 4, times Nigeria income. Step 4 times step 2. Global adjusted profit ratio times what? Nigeria income. Global adjusted profit ratio times Nigeria income. I will get Nigeria adjusted profit. Because it is Nigeria adjusted profit that will be subjected to tax in Nigeria, not global adjusted profit. Step 7, compute capital allowance relief. What I mean by this capital allowance relief means Nigeria capital allowance. Nigeria capital allowance. That is what I mean. Nigeria capital allowance. How do I get Nigeria capital allowance? Depreciation relief ratio. Step 5, that depreciation allowance ratio times Nigeria income. Depreciation allowance ratio times Nigeria income. Depreciation allowance ratio times Nigeria income. I will get my Nigeria capital allowance. Step 8, determine the total profit or taxable profit. Another name for total profit means taxable profit. I want to get the total profit or taxable profit in Nigeria. Determine the total profit or taxable profit In what? In Nigeria. How do I get that? Nigeria adjusted profits less capital allowance. Nigeria adjusted profit less capital allowance relief. I will get my total profit, which is otherwise called taxable profit. I will get my total profit, which is otherwise called taxable profit. After that, determine the tax payable by applying the tax rate on the total profit. This taxable profit or total profit. I will determine the tax payable. How do I determine my tax payable? CIT. They are going to pay CIT, company income tax. They will pay education tax. Do you understand? Why some of the companies, they can pay NICDA, National Information Technology Development Agency levy. Likewise, too, they will pay police development levy. I will apply the appropriate tax. So those are the steps in computing taxation of airline, shipping, and telecommunication company. Those are the steps when we apply in computing taxation of airline, shipping, and telecommunication company. Now, based on this, let's look at illustrations. Let's look at illustrations. Illustrations. Examinable question 1. If you go to the back of the material, examinable question 1. Flying Eagle Limited. Flying Eagle Limited is a foreign company. Flying Eagle Limited is a foreign airline company. Has been involved in businesses of transporting passenger and goods to and from Nigeria since 2010. The financial results of the company's operation for the year ended 31st December 2023 are as follows. Income from cargo out of Nigeria. Income from cargo into Nigeria. Income from passenger freight. Income from passenger freight into Nigeria. While the total income is 120 million. Less expenses. The expenses is wages and salaries. Depreciation 6 million. Other expenses 17.2 million. Net profits 62 million. Other expenses include income tax provisions, general provision for bad debt, donation to University of Abuja, donation to political parties, other disallowable expenses. So that is that. The Federal Inland Revenue has obtained a satisfactory evidence that the basis adopted by the tax authority of the country in which the company is registered for the computation of an assessment of profit and loss engaged in airline is not material different used in Nigeria, and the relevant ratio have been certified by foreign tax authorities. You are required to compute A, company adjusted profits, B, company adjusted profit ratio and depreciation, C, total profit of the company for Nigeria tax purposes, D, tax liability of the company for the relevant year of assessment. E, how will the company be assessed to Nigeria tax if FRS is not certified that the tax authority of the airline home country compute assess to tax the profit of the airline company on the basis not material different from that prescribed by CETA 1 mark. So this is a question on taxation of airline, shipping, and telecommunication company. This is a question of taxation of airline, shipping, and telecommunication company. How do we approach them? First and foremost, we look at the income. The income side, we go back to our step when we want to compute the tax. We said step 1 is to determine what? Global income. Step 1 is to determine global income. We follow the step. So, back to this question. How do we get global income? All the income from all the countries that they operate. All the countries that they operate. All the income. So, if you look at my working notes, step 1 is there. Global income amount. The global income amount. Income from cargo out of Nigeria. Cargo freight out of Nigeria. Income from cargo freight into Nigeria. Income from passenger freight. Income from passenger freight into Nigeria. I had all the income together. All the summation of the income in the question is what? Global what? Income. That is the step 1. Any question? Any question? Can we proceed?
It's quite clear. Yes, sir.
Okay. Now, step 2. Determine Nigeria income. How do I get Nigeria income? From the global income, I will get my Nigeria income. Anything that is coming from Nigeria, that the source is from Nigeria. Take, for instance, income from cargo, freight out of Nigeria. It means that thing is coming from where? Nigeria. Out of Nigeria. It means it's moving out from Nigeria. Do you understand? Second, income from passenger freight. You know, they give us income from passenger freight, 20 million. They also give us income from passenger freight into Nigeria, 25 million. That is how the question was. But this area is an examinable question. The first one, they just write income from passenger freight. They do not say out of Nigeria. But the second one said income from passenger freight into Nigeria. What that one means is that the one that they write income from passenger freight, that one means it's going to be out of Nigeria. Because The second one is income from passenger flight into what? Nigeria. This is an examinable question. The question is silent. The question is supposed to write income from passenger flight out of Nigeria. You know, they have two goods, cargo and passenger. We have mentioned the one of cargo. Now, passenger. The first one that they write, they said income from passenger flight, 20 million. Income from passenger flight into Nigeria, 25 million. That one is not Nigeria income. But the first one, income from passenger flight, since the second one is not Nigeria income, they say into Nigeria. That means that first one will be what? Out of Nigeria. Will be Nigeria income. So my Nigeria income now, based on this question, is going to be income from cargo flight out of Nigeria, 45 million. Income from passenger flight, 20 million. This passenger flight means is out of Nigeria, is coming from Nigeria. Because another passenger flight that they gave us, they said that one is coming into Nigeria. Once one is coming into Nigeria, the second one must be coming out of Nigeria, meaning the source is from Nigeria. So Nigeria income is now 65 million. Step 3, compute global adjusted profits. If I want to get my global adjusted profit, my global income, which is 120, I will now less allowable expenses. From the question, what are the allowable expenses? Number one allowable expenses I have in the question, if you go back to the questions. Wages and salary is allowable expenses. I will less it. Depreciation is disallowable expenses. I will not less that one. Other expenses, they now give us the breakdown of other expenses. Out of other expenses, income tax provision is a disallowable expenses. General provision for doubtful debt is a disallowable expense. But donation to University of Abuja is a public institution. So when a company donates to a public institution, it is allowed. So only one that is allowed in this question now is donation to University of Abuja. Donation to political party is not allowed. Other disallowable expenses is not allowed. So the only allowable expenses under other expenses, you know, they give us the breakdown of these other expenses. The other expenses is 17.2 million. They now give us the breakdown of it. What comprises of that 17.2 million? What comprises of it? What comprises that 17.2 million? They gave us the breakdown of it. So if we add 7 million, 3 million, 1.2 million, 2 million, and 4 million together, it will give you 17.2 million. Out of this 17.2 million, the only one that is allowed among them is what? 1.2 million, which is donation to the University of Abuja. So my allowable expenses out of all these disallowable expenses. So what I do in my computation is, for me to get that 1.2 million, I minus all the disallowable expenses from the total other expenses of 17.2 million, so that at the end of the day, I get what? 1.2 million. So wages and salary is 34 million. So my total allowable expenses will be 34,800,000 plus 1.2 million, which is going to give me what? 36 million. I will now minus the 36 million from the global income. I will minus it from the global income. At the end of the day, I will get my global adjusted profit will be what? 84 million. My global adjusted profit will be what? 84 million. After I get my global adjusted profit of 84 million. The next, another approach that I can use to get my global adjusted profit. I can use net profit approach. The first approach I show you is global income approach to get my global adjusted profit. Another approach is I can use net profit approach by saying net profit add disallowable expenses. Net profit add all disallowable expenses. You can see that I'm still going to get the same 80 what? 84 million. Do we understand? Are we clear with this?
Yes, sir. Yes, sir. We are clear, sir.
Okay. That is step 3, global adjusted profit. After I get my global adjusted profit, I will now ask myself, I will compute my global adjusted profit ratio. Global adjusted profit ratio. Global adjusted profit all over global income times 100. This 84 million, which I get all over global income, which is step 1, times what? 100. I will get my global adjusted profit ratio. So in this case, my global adjusted profit ratio is what? 70%, which is this. Can we see that? Now, from that, from global adjusted profit ratio, I can get my Nigeria adjusted profit. Nigeria adjusted profit. If I want to get my Nigeria adjusted profit, I would rather set my global adjusted profit ratio 70% times Nigeria income. Step 2, my Nigeria income, we can see it is 65 million. Do you understand? I will get my Nigeria adjusted profit. If I get my Nigeria adjusted profit, because the main requirement of this question is for us to compute the tax liability, I will now go to the main working, the main answer to the question, which is the first heading. Look at my first heading. I said Fly Eagle Limited, computation of tax liability for 2024 year of assessment. Nigeria adjusted profit, Nigeria capital allowance, tax liability, taxable profit, and now compute the tax liability. This is the main requirement of the question. Now, since I get my Nigeria adjusted profit, which is 45 million naira, 45.5 million naira, I will now take it to the main solution of the question. As part of the main solution of the question, I will now call it working 5. You can see working 5, Nigeria adjusted profit, 45,500,000. Do we understand? I will put it there as part of the main working, main solution to the question. Go back to the working notes. I've gotten my Nigeria adjusted profit. The next step is for me to get depreciation allowance ratio. Depreciation allowance ratio. My depreciation in the question, 6 million. All over global income, 120 million. You can see the depreciation in the question. If you go to the question, you will see depreciation of 6 million. This is the depreciation. So Nigeria capital allowance is 5% of that depreciation relief ratio times 65 million. You are going to get 3,250,000. That is the Nigeria capital allowance. Once you get your Nigeria capital allowance, you go back to the main working of the question, the main solution to the question. You now go and less Nigeria capital allowance from Nigeria adjusted profit. You go and less Nigeria capital allowance from Nigeria adjusted profit. So you will less Nigeria capital allowance from Nigeria adjusted profit. So you can see how we get Nigeria capital allowance is the last working note after depreciation allowance. And I get my Nigeria capital allowance. 5% times 65 million is giving me 3,250,000. Do we understand? So that is how I get Nigeria capital allowance. I will now go to the main solution. This is the main solution. Nigeria adjusted profit. I show you how we get that. Nigeria capital allowance, I will less it from Nigeria adjusted profit. I will now get what is called taxable profit or total profit. Taxable profit or what? Total profit. Once I get that, the next thing I will do is to compute what? Tax liability. The next thing I will do is to do what? Compute tax liability. For company income tax rate depends on the range of the turnover. Company income tax rate based on Finance Act 2020, it depends on what? The range of the turnover. If your range of turnover is 0 to 25 million, the company income tax rate is 0%. If the range of turnover is more than 25 million to 100 million, the company income tax rate is 20%. If your range of turnover is more than 100 million, the company income tax rate is how many percent? 30%. Do we understand? Do we understand? Do we understand, class?
No, so you said from 25 million to 100 million is what rate?
From 0% to 25 million. Your company income tax rate is 0%. You are not going to, if your turnover is 0 naira to 25 million naira, from 0 in a year, if your turnover fall between 0 to 25 million, you will not pay company income tax. So let me just do something on that company income tax for you.
Sorry, you didn't answer me, sorry.
Yeah.
I said 25 to 100 million is what rate, please?
25 to 100 million.
Yes, sir.
25 to 100
million to 100 million.
Look at my table. Let me do something.
Okay, sir.
0 to 25 million. CIT rate, company income tax rate. If it is 0 to 25 million, your turnover, this is turnover. This is your turnover. 0 to 25 million. In a year, if your turnover is 0 to 25 million, the CIT rate is what? 0%. What that one means is that you not pay company income tax. Finance Act normally call this type of company small companies. Do we understand? But above 25M.
I want to ask,
Yes.
For how
You
long
can
will
ask
that
your
work?
question. What do you say? What do you say? What is your question?
For how long will that work? Where the threshold is for year 2021?
Yeah, it's from
for you
year
to be taxable.
2020 to date. From
Okay,
year 20.
for example, yeah, I understand with you, sir. For example, your business make 24 million year one, second year 24 million, third year 24 million, fifth year. So how long will that last? Like,
So far as you are
specific?
making less than 25 million, any year
You're not
that
going to
you
be
make
paying
less
tax.
than
Okay.
25 million, you will not pay company income tax.
All right, sir.
Yeah?
I understand with you now, sir.
This one, 20%. Finance Act call it medium enterprise. Medium enterprise, that is what Finance Act call them. Finance Act 2020. Why the last one? Above 100M. Any time your turnover is more than 100 million, you pay 30%. You are referred to large companies. Do we understand? This is the deciding factor on how we compute company income tax rates. Prior to 2020, if you want to compute company income tax rate, we just use 30% of the taxable profits. But Finance Act have changed it now. Now, go back to our question. This is our question. For this company now, what is their turnover in a year? Who can answer me? What is the turnover of this company in a year? Based on what we have been discussing so far.
$120 million.
$120 million, sir.
Hello, sir, are you there? Otilo.
The turnover of the company is 65 million. Nigeria income. This is Nigeria income, 65 million. That is the turnover of the company. So if you look at this, 65 million, it fall within this range. 25 million, above 25 million to 100 million. So we are going to use how many percent? 20%. So that is what make us in this solution. If you look at the solutions, the tax liability for CIT, I use how many percent? 20%. So it's going to be 20% of taxable profit. 20% of what? Taxable profit. CIT, company income tax, is based on total profit or taxable profit. So 20% of this, you get 8,450,000. Education tax, TET, tertiary education tax. For tertiary education tax, Finance Act 2021, Finance Act 2021 changed the structure of tertiary education tax. Before, tertiary education tax is 2% education tax. But Finance Act 2021 changes to 2.5%. What that one means is that for tertiary education tax, we need to be careful. Year end of 2019, we are going to use 2%. Year end of 2020, we are going to use 2%. But year end of 2021, we are going to use 2.5%. Year end of 2022, we are going to use 2.5%. Of recent, Finance Act 2023 change tertiary education tax from 2.5% to 3%. It means year end of 2023, we are going to use how many percent for tertiary education tax?
3%.
So if you look at this question, the year end is 2023, while the year of assessment is what? 2024. Do you understand? So that is the reason why we use 3%. Assuming the year end is 2022, while the year of assessment is 2023, what percentage are we going to use?
2.5%.
2.5%. What about year end of 2020, year of assessment 2021?
2%.
2%. So we need to be careful on TET. It depends on the year end. So tertiary education tax is based on adjusted profit. It's not based on taxable profit. It's based on what? Adjusted what? Profit. So it's going to be based on this 45,500,000. It's based on adjusted profit, which is this 45,500,000. Do we understand? So if you look at my tax computation, I use 3% of adjusted profit.
I have a question, sir.
Okay.
So, though I can't remember the exact this scenario, right? But one of the lecturers told us that once there is a new law, whether the account given to us to solve is the previous years, that we should keep applying the new laws on the accounts.
It does not apply like that. It does not apply like that, sir. Effective from, it depends on the year. We can't be applying a new law on the old accounts. No. It's assuming somebody owing VAT in 2014 is owing a VAT. What rate are we going to use for VAT in 2014? That they are owing 5%. Do you understand? A customer is owing you a customer buy a good in 2014 and you had the VAT to it 5%. That customer have not paid up to now. You now want to collect the money from the customer. Are you going to say you are going to adjust the VAT to 7.5%? Yeah? I'm asking.
No.
You are going to use 5%. You can't use 7.5%. Because as at that date of transaction, that is the rate of tax.
It's true. It's based on the law, not like
Yeah.
pricing and all that.
Yeah. So that is that. The next type of tax I will compute for this company is police development levy. Police development levy started in 2021 account, which is 2022 year of assessment. Finance Act 2021 introduced police development levy, and it started in 2021 account. Police development levy, the law said, is going to be 0.005% of adjusted profit. It's so lean, very minimal. You can see when I apply it on this 45,500,000, it's giving me how much? 2,275 naira. They started paying police development levy in 2021 year end, which is 2022 year of assessment. Do we understand? So this is the tax liability for this company. In this question we solve, the examiner in the question, they did not give us capital allowance. They did not give us capital allowance. That is the reason why we compute depreciation allowance ratio. Assuming they give us capital allowance, we will not compute depreciation allowance ratio. We just use the capital allowance given to us direct. Let's look at illustration 2, examinable question 2. Abib Limited is a foreign company involved in air transport business. Its aircraft are used for cargo and passenger flights between Nigeria and Spain. The audited financial statement for the year ended December 31st, 2023, revealed the following. Income from passenger from Madrid to Nigeria. Income from passenger flown from Nigeria to Madrid. Income from cargo loaded into aircraft on other routes. Income from cargo flight from Nigeria to Madrid. Deduct operating expenses, depreciation, staff salary, use of airports, accommodation, hotel bill for passenger, general provision for doubtful debts, operating profits. In addition to the above, capital allowance is agreed with the relevant tax authority to be what? 175% of depreciation. Required. Compute the income tax liability for assessment year 2024. Ignore minimum tax computations. Ignore minimum tax computations. So you will go, when you are solving it, your first writing is to write the requirement of the examiner, Abib Limited, computation of tax liability for 2024 year of assessment. For yearline, if I want to compute tax liability, my Nigeria adjusted profit, I will less Nigeria capital allowance, I will get my taxable profit, I will now compute tax liability. This is the main solution. I will now write the main solution first. I will leave line for the main solution. I will now be doing the working notes. Working note number 1, global income. Global income means all the income from all the countries that they operated. You can see, I add all the income together based on this question. All the income, starting from this place to this, they are the global income. I write them. They are the global income. Out of this global income, I will now go to step 2. Say Nigeria, what? Income. Nigeria income. How do I get my Nigeria income? Income from passenger flown from Nigeria to what? To Madrid. It's coming from Nigeria. It's Nigeria income. Income from cargo from Nigeria to Madrid is Nigeria income. So out of these 4 income, 2 belong to Nigeria. I will add them together. Step 3, I will compute my global adjusted profit. Like I said, 2 methods I can use. I can use either global income approach or net profit approach. Global income approach, I will say my global income less allowable expenses. This is all the allowable expenses. Out of all these expenses given to us, let's even analyze the expenses. Depreciation is a disallowable expense. We all know that. Staff salary, is it not allowable expenses? It's allowed. Use of airport facility, airport facility, is it allowed? Allowed. Accommodation for time crew. Allowed. Hotel for passenger. Allowed. What about general provision for that bad debt?
Not allowed.
Not allowed.
Disallowed.
Disallowed. Provision for bad debt is into 3. We have general provision for bad debt, specific provision for bad debt, and bad debt written off. Out of the 3 I mentioned, which one is allowed, which one is disallowed? Explain.
Specific is allowed.
Specific is allowed, and
bad debt written off.
Bad debt written off is allowed.
It's allowed. It's only general provision for bad debt is what?
It's not allowed.
So let's be careful of that. Now you can see I minus all the allowable expenses from the global income. I get what is called the global adjusted profit. Second approach. The second approach. Net profits. I add what? All the disallowable expenses. I still get what? The same answer. The same answer. I still get 32,497,350. 32,497,350. Do we understand? Any one of the approach you can use. In an exam, you can't use the 2 approaches. It's either you use one. But if you want to let the examiner know that you are too good, but time will not permit you that. Time will not permit you that. Do we understand? That is global adjusted profit ratio. Step 3. That is global adjusted profit is step 3. Step 4, global adjusted profit ratio, gap ratio. My global adjusted profit, which is this step 3, all over global income, which is step 1. This global adjusted profit ratio, this one, all over the global income. The global income is the step 1, which is this amount, 33,457,850 times 100. I will get 97%. I will get 97%. After that, the next thing is Nigeria adjusted profit. My Nigeria adjusted profit, this gap ratio, this 97% times Nigeria income times Nigeria income. This is Nigeria income, 26,772,250. I will times it. I will get my Nigeria adjusted profit. Once I get my Nigeria adjusted profit, I will go back to the main solution. My Nigeria adjusted profit, working note 5. Main solution. Main solution. The first thing I will write, Nigeria adjusted profit, working note 5, 26,003,678. Do you understand? Now, the examiner tells us that in this question, the examiner tells us that the capital allowance that they agree with the relevant tax authority is what? 175% of depreciation. It means Nigeria capital allowance is 175% of depreciation. So, assuming they did not tell us this, we will do depreciation relief ratio. But since they have tell us this, we will not do depreciation relief ratio. We will use this 175% direct. We will use it direct. So, if you look at my working, Nigeria capital allowance, that depreciation rate given to us in the question, 175%, times that capital allowance rate times depreciation. Because they said, the question said, capital allowance were agreed with relevant tax authority as 175% of depreciation. So my Nigeria capital allowance will be 175% of the depreciation, which is giving me 805, which is giving me 805,000. Once I get it, I will go back to the main solution at the beginning. My Nigeria capital allowance, so working note 6, 805. I will minus it from adjusted what? Profit. I will minus it from adjusted profit. This is the adjusted profit. I will minus it from there. I will get my taxable profit, which is this. I will now compute my tax liability. So CIT is still 20% because the Nigeria income in this question, which we are going to use as turnover, is 26 million. Assuming the Nigerian income is less than 25 million, they will not pay CIT. They will not pay education tax. They will not pay police development levy. Small company don't pay tax. Small company don't pay any tax. Small company, as it is right now, they will not pay any tax. So far as their turnover is less than 25 million, they will not pay company income tax, they will not pay education tax, they will not pay police development levy. But in this question, their turnover is more than 25 million, it's 26 million. So it falls within the range of this, which is still 20%. So 20% of adjusted profits, 20% of taxable profits, 20% of taxable profits, which is 25,198,678. I will get the amount of CIT. My EDT, 3% of adjusted profit. Our adjusted profit is 26 million. We'll get that. And my PDA, 0. So at the end of the day, you get your total tax liability. You get your what? Total tax liability. So that is it on question of taxation of airline, shipping, and telecommunication company.
Please, I have a question.
Okay.
So you said that small size businesses do not pay any tax at all, considering the 0% given. So my question is, which companies pays a minimum tax? Like when do a company are required to pay a minimum tax of, I think 1%,
Yes.
right?
See, this small company, they will not pay any tax. They will not also pay minimum tax. But this one, these two, we will compute their tax computation. We also test their minimum tax. Assuming, the 20%, this one is 20%. The CIT of this one is 20%. Assuming the minimum tax of this one is more than 20%, this company will be assessed based on minimum tax. Assuming the minimum tax of this one, when we compute it, is more than the normal tax computation of 30%, they will be assessed to minimum tax. The question I want to ask is, what is the minimum tax for company? CIT minimum tax. What is the rate of CIT minimum tax? Who can answer? The rate of
0.5% on the turnover. 0.5% on the turnover.
0.5% of the turnover. 0.5% of the turnover from normal manufacturing company and service company. 0.5% of the turnover. But you are right. But I will not direct you. Minimum tax also depend on the year of assessment. Minimum tax also depend on year of assessment. If your year of assessment is 2021, year of assessment, 2020 year of assessment, 2020 year of assessment, 2021 year of assessment, 2022 year of assessment. They said because of COVID, according to Finance Act, that said minimum tax is 0.5% of turnover. He now said because of COVID, for the first 3 years, company, their minimum tax, all company, their minimum tax, because of COVID-19, all company, their minimum tax will be half of the minimum tax stated in the law. Half of the minimum tax stated in the law is how many percent? 0. What?
0.25.
25%. It means all company, all manufacturing and service company for 2021 year of assessment, 2020 year of assessment, half of 50%, half of 0.5%, half of 0.5. So this one is 2022. Do you understand? But as from 2023 year of assessment, the minimum tax have come back to what? Normal rate of what? 50% of turnover. 2024 too. Still the normal what? Rate. So you are right for saying 0.5% of turnover. But you have said, however, for 2020 year of assessment, 2021 year of assessment, 2022 year of assessment, due to impact of COVID on businesses, their minimum tax was reduced to 0.25%. Do we understand? Do we understand? You can ask a question. This is an advanced tax. Eh?
So, okay, I think I'm not really cleared on what determines whether a company is to pay minimum tax or not, like the condition
See,
to pay
all
minimum
companies
tax.
pay minimum tax, except small companies, except this green, this yellow cannot pay minimum tax.
Okay, sir.
Do you understand?
Yes,
If
sir.
your
They pay
turnover is more than 25 million,
yes, sir.
you will assess to tax based on normal computation. You assess to tax based on minimum tax. Assuming company A, let me use example for you on this minimum tax. Company
Okay.
A, their taxable profits, the taxable
Yes.
profit of the company A is 16 million. 16 million. The turnover in that year for company A is 50 million. 50 million. Do you understand?
Yes, sir.
If I are asked to compute the company income tax, CIT, I will not say CIT will be, because the turnover is 50 million, it's going to be at what rate?
20%.
20%. So it's going to be 20% of this taxable profit, Abi.
Yes, sir.
This is the normal CIT. I will not say, or the minimum CIT tax he can pay, that minimum tax apply to CIT. Minimum tax apply to what?
CIT.
CIT. Or minimum tax he can pay based on this CIT is going to be, let's say, the year of assessment for this company A. The year of assessment. Year of assessment is 2023. So the minimum tax is going to be paid, is going to be 50% times the what? The turnover.
Okay.
You can say that the normal tax computation is 3.2. The minimum tax is what? 250, Abi? Eh?
Yes, sir.
If you
Though we
want to
can't
pay
see your
CIT,
screen.
which one is he going to pay? You can't see my screen.
Yes, sir.
Are you seeing the screen now?
No,
But
sir. We
see,
only
it's
see your
not pointing
materials.
to what you're explaining.
Eh?
We only seen the material, the lecture material, not the solving you are doing.
Not the solving.
Yes,
Let me
sir.
share. Let me share the solvings. Have you seen the survey now?
Yes, we can see.
Look at what I'm saying for CIT rate. I said small company, 0 to 25 million. What rate is he going to pay? 0%, Abby? Yeah?
Yes. Yes, sir.
Small company is not going to pay any tax. Above 25 million to 100 million, how many percent?
20%.
20% CIT. Above 100 million, how many percent?
30%.
30%. Based on minimum tax explanation and explaining, I said year of assessment. If your year of assessment is 2020, what rate of minimum tax are you going to pay?
0.25%.
21 year of assessment. 2021, still 0. Abi?
Yes, sir.
They said 3 years after COVID. Do you understand? As from 2023, the minimum tax has come back to the normal rate of how much?
0.50.
0.50. I now use an illustration. Company A. Company A, the year of assessment is 2023. The taxable profit is 16 million. The turnover is 50 million.
Come on, man.
The normal tax computation for CIT, because the turnover is 50 million, the rate of CIT will be what? The rate of CIT will be what?
20%.
So 20% of taxable profit, 20% of 16 million, it give you what? 3.2 million. Do you understand?
Yes, sir.
Now, assuming, I will not say, or minimum tax of this CIT. The minimum tax of this CIT is going to be based on turnover. We are in 2023 year of assessment. It means we are going to use 50% of what? Turnover, which means 50% of 50 million. Can you see it? Huh?
Yes, sir.
We can see, sir.
50%, if you want to compute minimum tax for this company, it's going to be 50% of 50 million. 50% of the turnover, or 0.50%, sorry. 0.50% of what? Of the turnover. When we compute that, it gives us how much? 250, Abi?
Yes, sir.
Minimum tax for this company is less than the normal tax computation. Which, out of these two, out of A, normal tax computation, B, minimum tax. If FRS want to assess this company to tax, which one FRS is going to take?
The higher.
The
higher, which is what? 3.2 million.
3.2.
Assuming the taxable profit now is 6 million or 2 million. 2 million. The taxable profit is 2 million. The minimum tax, the turnover still remains 50 million. The taxable profit is 2 million. It's still higher. Let's say the taxable profit is 1 million. You can see that the normal tax computation is how much? 200,000, Abi? The minimum tax is how much?
250.
So if this company want to access to CIT, how much this company is going to pay?
The minimum tax.
250. Do we understand?
Yes, sir. Yes, sir. It's clear now.
It's clear now?
Yes, sir.
Okay. So that is how we compute minimum tax for company. Back to our question, back to our solutions. For airline, shipping, telecommunication company, their own minimum tax is stated clearly in the Finance Act. Their own minimum tax is 2%. They are the ones that have specific minimum tax. Airline, shipping, telecommunication company, they have specific minimum tax of what? 2% of turnover. Do we understand? So, but in the solution that we do, the question said we should ignore what? Minimum tax.
Okay.
Eh?
Okay. So, except the question states we should ignore minimum tax, we should always compute minimum tax for
We
every.
should always compute minimum tax when we are doing
Okay.
solution.
So,
Eh?
yes, sir.
So, looking at this question of airline, shipping, telecommunication company I solved for you, this number 2 question. Assuming the question did not say we should ignore minimum tax. If we want to compute minimum tax for this company now, our minimum tax for this company for CIT, the CIT, only CIT has minimum tax. Education tax don't have minimum tax. Only CIT has minimum tax. So the minimum tax for this question now, I will compare the minimum tax with this CIT. If I want to do the minimum tax for this question now, I will now say the minimum tax will be 2% of turnover. What is the turnover? The turnover is the Nigeria income, which is how much? The Nigeria income, 26 million. So if you look at 2% of this, it's less than the normal tax computation of 20% of
the taxable profit.
So the company will be assessed to tax based on what?
Based on taxable profit.
Normal tax computation, based on taxable profit. They will not be assessed to tax on minimum tax. The only condition where they will be assessed to tax on minimum tax is when their minimum tax is more than the normal tax computation, which is based on taxable profits. Do we understand? Eh?
Yes, sir.
Okay. So thank you very much. So I will just do introduction to taxation of bank. Still on specialized business. Specialized business. Taxation of bank. If we go to the beginning now, let me go back. I mentioned specialized business. Airline, shipping, and telecommunication company. I've solved that. I'm going to number 2 now, which is bank. Taxation of what? Banks. So let me just do the brief introduction of it. Taxation of banks. Banks are subjected to tax in the same way and manner in which other incorporated companies are liable to tax. Essentially, banks and other financial institutions are liable to tax under what? Company income tax. Banks are required to file monthly return and annual tax return. One of the monthly returns banks are required to file is any customer that come to open corporate bank account with them, they need to be sending FRS, the TIN number of that customer. Because one of the requirements for a company to open a bank account is you must have a TIN number. And if any company open a bank account with a bank, FRS, they must send the TIN number every month to FRS. Do we understand? So the major income of a bank is what? What is the major income of a bank? What is the major income of a bank? Answer now. The major source of income of a bank is what? Eh?
No, the interest.
Interest on loan. Interest on what?
No.
Loan. Interest on loan are the major income of a bank. Interest on loan. However, there are some interest on loan earned by bank, but is not subjected to what? Tax. However, there are some what? Interest on loan earned by bank. Apart from interest on loan, there are some other income of a bank, like account and transactional fee, underwriting fee, advisory fee, management fee, admin fees, account maintenance fees, insurance commissions. So you should be able to know at least 5 sources of income of a bank. If you are asked, list 5 taxable income of a bank. Number 1, advisory fee. Account and transactional is taxable. Underwriting fee is taxable. Management fee is taxable. Admin fee is taxable. Commission on turnover is taxable. Account maintenance fee is taxable. Insurance commission is taxable. However, interest on loan too is taxable. But there are some interest on loan that bank receive as an income, but they will not pay tax on it. Income exempted from tax earned by bank. We want to list some of the income earned by bank that is not subjected to tax. That if they receive such kind of income, they will not pay tax on it. Number one, interest on loan granted by bank to a manufacturing good for export. When a bank give a loan to a company that normally manufacture good, and when the company manufacture good, when that company manufacture is good, it normally export it out of Nigeria. If a bank give them a loan, the interest earned by the bank, out of the interest earned by bank, certain amount will not be subjected to tax. Subject to, there are some conditions. If a bank give a loan to manufacturing goods for export, for the interest not to be subjected to tax, it must, the following condition must be occur. Number 1 is the beneficiary company, that company that normally manufactures goods for export, must export at least more than 50% of the good in manufacture in Nigeria. It must be exported out of Nigeria. Based on my notes, I said the beneficiary must export not less than 50% of its manufactured goods. Is still more than what we are saying is, if a company, they normally manufacture goods, maybe they normally manufacture clothes, and when they manufacture the clothes in Nigeria, they normally export it. The law is saying that in a year, they must export out of their production, they must export more than 50% of it out of Nigeria before you can set the interest on loan given to them by bank will not be subjected to tax. Second condition is the company, that manufacturing company, must obtain certificate of export from Nigeria Export Promotion Council. Certificate of export must be obtained from Nigeria Export Promotion Council. Why the last condition is that the rate of exemption shall be the following. If the repayment period of the loan is above 2 years, the moratorium period, which is the grace period, must not less than 2 years. 70% of the interest will be exempted from tax. But if the repayment period is between 5 to 7 years, the moratorium period must not less than 18 months. 40% of the interest must be exempted from tax. If the repayment period is between 2 to 4 years, the moratorium period must not less than 12 months. 10% of the interest earned by bank will be exempted from tax. Why? If the repayment period is less than 2 years, anytime bank give a loan to manufacturing good for export, if the repayment period is less than 2 years, it means all the interest earned by bank will be subjected to tax. There will not be exemption. There will not be rate of exemption. There will not be what? Rate of exemption. So, number one income of a bank that will be exempted from tax is income earned by bank from manufacturing goods for exports, which we just explained. Why number two? Number two is interest on loan granted by bank for primary agricultural production. If a bank give a loan to a company that do primary agricultural production, primary agricultural production means that company, they normally cultivate crops, they normally plant crops, or they normally rear animal. They are referred as what? Primary agricultural business. Planting of crop, rearing of animal. They are what? Primary agricultural business. If a bank give a loan to such company, such interest earned by bank will be exempted from tax, provided that the moratorium period, which is the grace period, is not less than 12 months. While the interest rate is not more than the base lending rate. The base lending rate is fixed by CBN. Sometimes the base lending rate is 21%. Sometimes it's 18%. So for agri business, for agricultural loan, if a bank give primary agricultural business a loan, that loan will not be exempted from tax if the moratorium period is not less than 12 months and the interest rate is not less than the base lending rate. So that is the second income exempted from tax. The third income exempted from tax. Income received by bank on interest on loan granted to a company engaged in fabrication of local plants. Fabrication of local plant is exempted from tax, provided that the moratorium period is not less than 18 months, while the interest rate is not less than the base lending rate. Another interest or income exempted from tax earned by bank. Interest on loan granted by bank to company engaged in cottage industry. Cottage industry means manufacturing of textile. Is going to be exempted from tax, provided that the moratorium period is not less than 12 months, the base lending rate is not more than, the interest rate is not more than the base lending rate. Another interest exempted from tax by bank, interest received by bank on federal government or state government security, such as stock, development stock, or bond, treasury bill, treasury certificate. When banks subtract from government security, any income, interest that they receive from that government security is not going to be subjected to tax. It's exempted from tax. Do we understand? Do we understand?
Sir, I have a question. Sorry.
Okay, what is your question?
So what's the meaning of this moratorium period?
Moratorium period means, assuming you collect a loan from bank now, and you are going to pay back for 10 years. Bank can say they give you 2 years moratorium period. 2 years moratorium period means out of the 10 years, for 2 years, you will not pay both principal and interest. It's after 2 years you start paying back. Do you understand?
Yes, sir.
This 12-month moratorium period means when a company collects a loan now, it means they are going to be paying back after how many months? After how many months? After 12 months. Do you understand? Do you understand?
Yes, sir.
So that is that. Another interest received by bank that is not subjected to tax. Interest earned by bank on foreign placement. If a bank have foreign investment, like they have rent foreign, they have dividend foreign, royalty foreign, provided that the proceeds of that income is brought to Nigeria through approved channel. If it's not brought back to Nigeria through approved channel, it's going to be subjected to tax. But if it's brought back to Nigeria through approved channel, it's going to be exempted from what? Tax. Another income exempted from tax by bank, dividend received by bank, is treated as what? Frank investment income. Dividend received by bank is treated as what? Frank investment income. So those are the income of a bank that is exempted from tax. So ladies and gentlemen, we must know at least 7 income of a bank that is exempted from tax, because there was a diet I can ask least income of a bank exempted from tax. 7. I've mentioned like 9 or 8. We must know at least 7. Please, let's take note of that. Let's now talk about disallowable expenses of the bank. Normally, the normal disallowable expenses, depreciation, general provision for bad doubtful debt, donation to unapproved body, loss on disposal of it, also apply to bank. They also apply for bank. Apart from that, there are some special expenses incurred by bank that is disallowable, that is not applicable to companies. So, special disallowable expenses of the bank. Number 1, increase in provision for performing loan. If a bank make provision for performing loan as an expenses, you see it in an expenses of a bank, you disallow it. In bank, we have 2 types of loan, performing loan and what? Non-performing loan. Performing loan means loan that is yet to be due. and customer is paying at the right time, why do we make provision for it? In the bank financial statement, they normally make provision for performing loan, but we in tax authority, we do what? What are we going to do with it?
We deduct it.
We disallow it. We add it back to bank net profit. You know, we normally add back disallowable expenses, Abi? Abi? We add it back to disallowable net profit to get our adjusted profit. Another one, increase in provision for other assets and accounting receivable. In bank expenses, bank will make provision for other assets. We don't know that. Nothing concerns us in tax. Who do you pay other asset provision? Do you actually pay it? Does it involve movement of cash? No. You are just making provision. All these impairments in your corporate reporting, it does not apply in tax. So if you see any impairment loss, it's disallowable in tax. It's disallowable because it's a non-cash item. It's disallowable expenses. Increase in provision for diminishing in value of investment is also disallowed. Increase in provision for advances under finance leave is also disallowed. Increase in provision for off-balance sheet engagement is also disallowed. Unrealized exchange loss is also disallowed. For unrealized exchange loss is disallowed, but realized exchange loss income, students, realized exchange loss income, is it going to be disallowed or allowed? Or allowed?
It should be allowed, sir.
It should be allowed, since unrealized is realized exchange loss means you have incurred that exchange loss gone. Unrealized means you make provision for exchange loss. Do we understand? Eh? Do we understand?
Yes, sir, we do.
That is it on bank. Number one area that we need to look on bank in this it is this agriculture. Number two, that income exempted from bank, agricultural business. We said if a bank give a primary agricultural business a loan, it's going to be exempted from tax. If the moratorium period is not less than 12 months and the interest rate is not more than what? Base lending rate. That we move off to an illustration. Illustration 3, examinable question 3. Examinable question 3. Somebody should read the examinable question 3 for us and see. Oh yeah, we need a volunteer to read for us. Examinable question 3.
Sir, it's 10 already.
Huh? It's 10. We must do this one, please. It's very simple. Let me read. Please. Interest on loan relating to primary agricultural business included in the income of ABC Bank Limited for the year ended 31st December 2021 is amounted to 5 million naira. The breakdown of the interest income based on the loan term is as follows. Repayment period, moratorium period, interest rate, agreed loan interest. They give us the breakdown of that 5 million. They now said the base lending rate in respect of the facility is 21% per annum. Require, compute the loan interest exempted from tax. Compute the loan interest exempted from tax. How do we compute the loan interest exempted from tax? In this question, look at the solutions. ABC Bank Limited, computation of loan interest exempted from tax for 2022 year of assessment, preceding year basis. Repayment period, moratorium period, interest rate, loan interest amount, interest exempted. For interest on loan granted to primary agricultural business, we have two factors that we need to consider: moratorium period and what? Interest rates. Look at the first interest. The repayment period is 5 years. The moratorium period is how many months? 24 months. While the interest rate is what? 15%. Based on the condition of agricultural loan, primary agricultural loan, they say the moratorium period must not less than 12 months. And the interest rate must not more than the base lending rate. So in this question, the moratorium period of this one is 24 months. Is it less than 12 months?
No, sir, it's not.
So it passed the moratorium period condition. This first one I'm doing, this first one, it passed the moratorium condition because the moratorium is 24 months. It does not less than 12 months. But for the interest rate, what is the rate of interest? 15%, Abi?
Yes, sir.
So based on this question, what is the base lending rate? What is the base lending rate?
21%.
Condition said the interest rate charged by bank must not what? Must not do what?
Be more than the base lending
rate. More than. So looking at this first one, the interest rate is 15%. It means it's not more than how many percent?
21%.
So it passed the two conditions. Since it passed the two conditions, this loan interest of 2.5% is going to be what?
Tax exempted.
Exempted. So that is the reason why I write it under interest exempted from tax. It passed the two conditions. It must pass the two conditions. Second loan given 3 years. The moratorium period is what? 6 months, Abi? Look at the second one now. Can you see? Class, can you see it?
Yes, sir, we can.
The moratorium period is less than 12 months. Because they said the moratorium period was not less than what? 12 months based on the condition. Look at this one. The moratorium period is 6 months. Is it not less than 12 months? It's less than 12 months. Does it pass the condition? Class, can you hear? Does it pass the condition?
No, sir.
It did not pass. Based on moratorium period, it failed. Based on interest rate, the interest rate must not more than the base lending rate. So it passed the interest rate. The interest rate is 20%. It's not more than 21%. But since it failed the moratorium period, this 800,000 is not going to be exempted from tax. Rather, it's going to be subjected to tax. So the amount exempted out of this 800,000 is 0. Can you see that? Do you understand? Third one, 2 years. The moratorium period is 18 months. It means it's more than 12 months. Abi? Does it pass? Does it pass the condition? It passed the condition because it's not less than 12 months. The interest rate is 14%. The interest rate is not more than 21%, it passed. So by virtue of that, it's not going to be exempted from, it's going to be exempted from tax. This one, 6 months, it does not pass because it's less than 12 months. Interest rate, 35%, it does not pass the 2. So the amount is not going to be exempted from tax. So the amount that will be here is 0. So the total amount that will be exempted from tax from all these 5 million is 3.2 million. By next week, I will explain further again. Please read those income exempted from tax very well, especially the agricultural and manufacturing good for export. A question normally comes from that area. You can see the scenario now. You look at 2 deciding factors: moratorium period, interest rates. Moratorium period must not less than 12 months. The interest rate must not more than base lending rates. So thank you very much. By next week, we continue again from bank. Thank you very much.
Thank you, sir.
Yeah. Any question? Any query?
So this moratorium period, you say it should not be less than 12 months, right? It must not
Yes.
be. Okay, but it can be more than 12 months.
Yes, it can be more than 12 months. So any other question? Any other question?
So I have a question on
Okay, what is
that
your question?
specialized companies.
Okay, ask.
While we were solving the illustration, right, there is an expense of hotel expenses for passengers, and you said is allowable. Like, I want to
Yes.
ask, is it aircraft that provide hotel expense? Are they the one that pay hotel expenses for passengers, or passengers do that themselves?
Normally, according to airline rule, if a passenger have a delay of flight,
Yes, sir.
who caused the delay?
Sir, I didn't get your question.
A
Sir.
passenger.
Yes, sir.
He's supposed to travel to abroad today. The
Yes,
flight
sir.
now today.
Mm-hmm.
He has planned that he will travel today. Then now say, the flight cannot go again. He's going to go next tomorrow. Who caused the delay?
The passenger. No, the airline.
The airline. So they need to give him an hotel where he's going to stay, because he has already prepared. He has already carried all his luggage.
All right, sir. Makes sense. Thank you, sir.
Yeah. Any other question? Any other question? So in the absence of no question, we can call it a day. So we meet by next week. Thank you very much. We start from a bank again. So thank you very much.